Welcome back to Lock It In with Cam Rogers. We're talking sports betting industry insight with one Art Hogan, Chief Market Strategist at B. Riley Wealth Management. Catch him on Twitter at Art Hogan, 3 L's. Art, appreciate the time, sir.
Thanks so much. Thanks for having me. Great to talk to you.
Let's talk about this global sports betting market, which is expected to grow from 89 billion in 2021 to 99 billion in 2022. When you see that kind of growth, Art, what does it signify for the betting industry and market value overall?
Yeah, great question. So I think you have to take a step back and say, how did we get here, right? And I think that going back to a Supreme Court decision in 2018, allowing states to make the decision as to whether or not they're going to allow gaming really started this brush fire. And since 2018 coming into this morning, we've got 31 states and Washington, D.C. that have made the decision. We would love to have those tax revenues in our state. Have made that legal. There's another 5 that will likely make that same decision over the course of the next 2 months. So the growth is explosive. As a matter of fact, if you just look at the gaming spend since the 2018 Supreme Court decision, it's estimated that we've seen about $162 billion, right? So everyone wants a piece of that revenue. Unfortunately, as a startup, take a company that's just been explosive in terms of a startup. DraftKings came public about 5 or 6 years ago. And they're arguably the front runner in getting people involved in this. They started with fantasy sports and then navigated their way into actual gambling on live sports events. But that comes at a cost. And that cost is what we refer to customer acquisition cost. So think about that like, Cam, your grandparents used to be offered a free bus ride to Atlantic City. They'd be given a roll of quarters, and hopefully they fall in love with whatever casino they went to and have return visits. Well, DraftKings is doing the same thing by giving out free bets. Welcome aboard. Your first $50 is free, and they've given out so far this year $220 million worth of bets. So what does that do? That cuts into their earnings, right? So their earnings are a few years out. And for publicly traded companies to not have earnings but have massive growth used to be a very popular thing. We saw that with Netflix ever since they shifted to streaming. We certainly saw that with Amazon for over a decade. They had a huge potential total addressable market, but it was going to be a while before they're profitable. Unfortunately, when interest rates start to rise, investors don't want to look to the future and say, I can't believe how much money you're going to make in 3 years. They really want to see some of that earnings now. And that's been one of the things that's been dogging DraftKings as compared to some of the incumbents that actually have brick and mortar buildings like a Las Vegas Sands. So DraftKings is down about 45% this year, down about 65% over the course of the last 12 months. And Las Vegas Sands is actually up and outperforming the S&P 500. And why is that? Well, the pandemic reopening got people back to Las Vegas. And unfortunately, they also have properties in places like Macau and China, Shanghai, and a lot of those places continue to be closed with the China zero COVID policy. But if you're thinking about the explosive growth, you have to temper your enthusiasm and think about how long will it be before some of these new and exciting companies are going to be profitable.
Yeah, absolutely. I mean, with DraftKings in particular, they've gotten a lot of bad headlines, shall we say. I mean, the shares have declined more than 44% this year. It's interesting. One analyst actually noted that now is a good time to buy in. It's a good entry point with DraftKings. What say you about that?
Yeah, and you always try to, what's very difficult, except in hindsight, is to say, okay, how much of the bad news or the delay in earnings or the customer acquisition spend is already priced into a stock. I would certainly say being down 45% this year and 60% over the course of the last 12 months probably is priced in a lot of the headwinds they're going to face. I think it's very transparent how much money people are spending to get these new customers. But what's hard to price in is how much competition is going to come from the incumbents. MGM, for example, has an exciting online offering. Obviously, they're competing with the DraftKings. Las Vegas Sands is doing the same thing. So the incumbents like a Penn Gaming isn't going to stand still and let DraftKings have the entire pie. There's going to be some battle for this total addressable market. Penn Gaming did something interesting about 18 months ago by bringing on Dave Portnoy from Barstool and hoping that would generate some buzz and give them a larger slice of the pie. So I would say that analyzing DraftKings in and of itself, it's certainly priced in a lot of the headwinds. Hard to know if they're going to face new and more arduous headwinds, but I would certainly say you're a lot closer to it being investable now than you were 12 months ago.
Talking about earnings and going into the green, if you will. Do these companies need more states to legalize, or can they survive, just in theory, if everything is status quo for the next 20 years? The states remain the same in terms of the laws and all that.
Yeah, you know what? That's a great question. I think the companies are built to have a national acceptance of gaming on a state by state basis, and let's face it, we've got 31 states already. There's another 5 that likely over the course of the next quarter or so have that vote, and so then you're talking about 35 or 36 states. There's not much more to really drop, and I think it's an industry that was really built on, hey, eventually this is going to be legal everywhere, very much like the cannabis industry is built that way, right? It's one state at a time, and now some form of cannabis is legal in about 40 states. So I think the cannabis industry is betting that eventually every state will have some form of acceptance of gaming, and I think that's why it's set up that way. I think they're very much set up with this big spend on the upfront, this big acquisition cost, a lot of advertising, and hopefully once they gain that traction, they can ratchet down that aggressive spend and start letting some of that top line revenue come down to the bottom line in terms of earnings.
Symbolic of that too. I mean, you're watching Monday Night Football and the game is still kind of going on, and then in the corner of your screen is a DraftKings commercial, right? So the amount of spending that this company has done is pretty amazing, and so hopefully it works out for them. I want to throw some numbers at you. Caesars down 47, Penn Entertainment down 22, and then DraftKings down as well over the course of the last year to date. When I give you those numbers, and I'm someone, by the way, who thinks we're heading in a great direction with sports betting. Obviously, I'm covering it and all that good stuff. But when I tell you those numbers, will you say back to me, just give it some time?
Yeah, I would. What I would tell you, here's the 3 things to think about. First and foremost, the market is a forward pricing mechanism, right? So the market's actually forecasting what's going to happen over the next 6 to 12 months, not what just happened over the last 12 months, right? So we try to price in what we think the potential headwinds will be for businesses, and they're getting to earnings positive. I think the second thing to think about is, like it or not, gambling is relatively recession proof, right? It's one of those things that tends to do better even in a slower economy, which we're likely to see at some point next year as the Fed gradually raises rates and economic activity slows down. And that's true globally as well, right? So you've got a touch of recession resistance, a lot of bad news already priced in, and a huge total addressable market that we really haven't scratched the surface on yet. So I think it's obviously it's a growth sector. I think once interest rates stop going up precipitously or parabolically like they have been, investors will feel more comfortable in what we refer to as a long duration trade. And that just means it's going to be a while before we show you earnings, but we're going to grow our revenues rapidly. So I think that the entirety of the space has some positives and probably more positives than negatives.
Well, how about this report that I saw in my research? It noted that the sports betting market value of 167 billion is going to happen by 2029. In those projections, do you see something like that as well? I feel like more and more companies are going to be publicly traded. You would think maybe FanDuel gets in the game, something like that, but that's a massive number by 2029.
Yeah, and it's not impossible to believe that. So I look at this as like any other revolution we've gone through, right? It was the start of the internet, 96, 97, 98. A lot of companies came public. A lot of them don't exist anymore. But the size of the internet-related online commerce and everything that it touches our life exploded over that 5-year period. The same kind of growth, I think, is going to be here for gaming. And it's not just the incumbents that we all know so well, like the MGMs and the Penns and the Las Vegas Sands of the world. There's, everybody wants a piece of this growing addressable market. It's becoming the norm, not the exception, for states to have laws that permit that. And I think that I think the revenue projections in the total addressable market are clearly achievable, but how to do it profitably is going to be the catchphrase. You really have to watch for the guys that are overspending to get in the business, paying too much to get clients in the door, and that's how you break a business model. And then what typically happens is some of the upstarts, some of the disruptors end up getting bought or acquired by some of the legacy players, because it's a lot cheaper to buy somebody oftentimes and say, okay, now we have MGM and DraftKings and FanDuel, or those types of things where incumbents can say, I just can't build it for the same price I could probably buy one of these upstarts, and bring them in with synergies and make it a viable business inside our old legacy business at casinos.
Art Hogan, Chief Market Strategist, joining Lock It In with Cam Rogers. Art, really good insight here. It's going to be really interesting to see where we are headed and what happens in this sports betting world. Appreciate the time.
Thank you so much. It's always a pleasure to see you.